here we are.
Glad to be here.
Explain to me what's going on.
Well, we had a huge run. I mean, the market was 4,000 just 2.5 years ago,
Yeah.
and it ran up to 8,300 in August. And like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow, and it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000, and that caused 7 years of inflated real estate, people overspending. And basically, they've been in a recession for 5 or 6 years because their market went up too high. I mean, if the market goes up too high, if the market goes too high, you're discounting earnings 7, 8, 10 years out. There's a relationship.
So everything is overpriced.
Yeah, and that doesn't help anything. The market since World War II has sold between 10 times earnings and 20 times earnings. If you look at the Dow Jones or the S&P 500, if you add up all the companies and take the earnings, you say there's a relationship. And it follows. McDonald's earnings have been terrific the last 30 years, and the stock's been terrific. There's a direct relationship. So the earnings of the S&P 500 have been between this range of 10 and 20. We were just about to go over the 20, which is the high end of the PE range. There wasn't a lot of room left on the PE
of 20
side.
is at the top of how high it should ever be.
Right. It's been over there only a few times ever over 20. And that's when usually inflation's about 0. In the early 60s, when inflation was about 0, we got a little bit over 20. Now